Okay, so you want to start a credit card company. Get a bank charter or rent one from somebody who already has it. Print your name on a rectangle of plastic, mail out a few million of them, and charge 22% to everyone who doesn't pay the balance in full. The money you lend isn't even yours. You borrow it at 4% from depositors and lend it at 22%, and the difference shows up every single month whether you get out of bed or not. That's the picture. A product with no factory, no warehouse, no shipping, no shelf space. Customers who fill out an application asking for permission to become your borrowers. A business where the customer carries your product in their pocket and does the selling for you, several times a day, every time they hand it to a cashier. Every swipe is revenue. Every balance is an annuity. Nothing physical ever has to move, and the whole operation runs on a wire. The problem is what happens between the offer and the repayment. That gap is where this entire business lives, and it is roughly 18 to 30 months long, which means you will not find out whether the decision you made today was a good one until you have already made it 2 million more times. Let's start with what you think you're selling. You think you're selling a loan. You're not, or at least not first. Before anybody borrows $1 from you, the card has to get used, and the moment it gets used, you get paid by somebody who never applied for anything and does not want to be your customer at all. That somebody is the merchant. Watch a $100 purchase move through the system. The customer taps the card and walks out with the goods. The merchant does not receive $100. The merchant receives about $97.75. The $2.25 that vanished is called the merchant discount, and it gets split 4 ways before the day is over. The largest piece by far, about $1.75 on a standard rewards card, goes to you. That's interchange. It is set by the network, not negotiated by you, and it is the reason a card business can exist at all. About 16 cents goes to Visa or MasterCard for running the rails and taking, essentially, no risk. The rest, 30-odd cents, goes to the merchant's own bank, the one that gave them the terminal. Now hold 2 facts next to each other because most people never do. Visa and MasterCard do not lend money. They do not fund balances, they do not eat defaults, and they do not care whether the cardholder ever pays. They collect a fraction of a percent on volume, and they run at operating margins north of 60%, which is a level of profitability almost nothing else in finance reaches. You, the issuer, collect 10 times as much per transaction as they do, and you are the one carrying every dollar of risk in the chain. That asymmetry is not an accident, it's the deal. The network sold the position with no downside and left the lending to you. So on paper, before a single person borrows anything, you are earning about 1.75% of everything your customers spend. On a card that gets $30,000 of annual spend, that's $525 a year of revenue from a customer who has not paid you 1 cent of interest. Here's where it gets interesting, because you are going to give almost all of that back. Nobody takes a card with no rewards. The American market has spent 25 years bidding away the interchange to the cardholder, and the going rate for a good flat rate card is 2% cashback. Run that against the interchange you just collected. You brought in $1.75 on that $100 purchase. You paid out $2. You are underwater by a quarter on a transaction where nothing went wrong. This is the single most misunderstood fact about the business. The customer who spends heavily and pays in full every month, the responsible one, the one with the 800 credit score, the one you'd be proud to have in your portfolio, is a loss. The industry has a word for that customer, and the word is not flattering. Roughly half of all active accounts never carry a balance from 1 month to the next. Half of your book, on the good side of the ledger, is consuming rewards, consuming fraud losses, consuming call center minutes, and paying you nothing but a fee stream that doesn't cover them. The other half pays for everything. Every lounge, every point, every sign-up bonus, every branch of the business that looks generous. All of it is funded by the people who cannot pay the balance at the end of the month. American consumers hand over more than $130 billion a year in credit card interest and fees. That is not a side effect of the business. That is the business, and everything else is packaging designed to get the card into the wallet before anyone finds out who they'll turn out to be. So let's build the customer you actually want and see what they're worth. Say a cardholder carries an average balance of $6,000 at 22%. That's $1,320 of interest a year. You funded that $6,000 with deposits costing you 4.5%, so subtract 270. You're at $1,050 of net interest. Now subtract what goes bad. Industry net charge-offs run around 4.5% of balances in an ordinary year, so take another 270 off. Subtract 75 for servicing, statements, payments processing, disputes, the fraud you eat, the person who answers the phone. On the spend side, this customer puts $18,000 a year through the card, generating about $325 of interchange against $270 of rewards, so add back 55. Add 60 in late fees, because a revolver is a person who is occasionally late. You net around $820 a year from one account. That is a spectacular return on $6,000 of exposure. Do it 4 million times, and you have a business that prints more money than almost anything else a bank is allowed to do. And notice what makes it work, because it isn't the interest rate, it's the repayment schedule. And the repayment schedule is something you designed. The minimum payment on a typical card is 1% of the balance plus the interest that accrued, or $35, whichever is greater. Put that against a $6,000 balance at 22%. The first minimum payment is about $170. About $110 of it is interest. $60 comes off the principal. Follow that schedule and never spend another dollar on the card, and the balance takes well over a decade to clear and costs more in interest than the original purchases. A customer who honestly intends to pay you back, who never misses, who does exactly what the statement asks, that customer stays on your books for 12 years. That is the whole design. The minimum payment is low enough to feel manageable, which is what keeps the customer paying, and low enough to barely touch the principal, which is what keeps the balance alive. You are not selling money at 22%. You are selling a payment small enough to say yes to. Now here's the other side of the ledger. That same customer, if they stop paying entirely, takes $6,000 with them. Recovery on a charged-off unsecured card balance is thin. You sell the paper to a collector for pennies, so call the real loss $5,200. One default erases more than 6 years of profit from a customer who behaves perfectly, which means the entire business, top to bottom, is a bet that fewer than a certain fraction of your customers go bad. Not a small bet, the whole bet. Every other line on the income statement is secondary to that one number, and that one number is set by an economy you don't control and by decisions your customers made years before they met you. This is where the first trap opens, and it opens on the way in. Nobody applies for a credit card because they woke up wanting one. You have to go get them. That means pre-screened offers, billions of pieces of mail a year across the industry, against response rates measured in fractions of 1%. It means a sign-up bonus, because a card without one is invisible. A competitive bonus on a mainstream rewards card costs you $200 to $300 in real money. On a premium card, it can cost $1,000 or more once you value the points at what people actually redeem them for. Add the mail, the underwriting, the bureau pulls, the fraud screening, and the plastic itself, and the rule of thumb lands between $200 and $500 to put one funded account on the books. Before that account has generated $1, and there is a cost line running underneath all of it that never appears in anybody's mental model of this business, because the marketing spent 30 years teaching people not to think about it. Zero liability. Report the charge, and it disappears off the statement. Somebody pays for that, and it's you. Card fraud in the United States runs well over $10 billion a year, and the share of it landing on issuers has been rising for a decade. After the chip rollout shifted counterfeit losses onto merchants who hadn't upgraded their terminals, the fraud didn't stop. It moved online, where there is no chip and no signature, and the issuer generally eats it. Every disputed transaction also carries a processing cost of $25 to $40 in human review and paperwork, win or lose. At 4 million accounts, A fraction of a percent of transactions going into dispute is a floor of employees. So a new account starts life deeply negative. It takes 12 to 24 months just to earn back what you paid to acquire it. And a meaningful share of accounts never get there at all. They take the bonus, hit the minimum spend, and go dormant in the sock drawer. You paid $700 for a customer who used the card for 4 months. Now stack accounting on top of that. Since 2020, American banks book expected lifetime credit losses at the moment the loan is created, not when it goes bad. So the day you open a new account and it draws a balance, you take a provision against losses that haven't happened yet and won't happen for 2 years. Sit with what that does. Every dollar of growth costs you money immediately and pays you back slowly. A card business that is expanding fast looks worse than one that is shrinking, and a card business that is shrinking looks profitable right up until the moment there's nothing left. Your reported earnings are inversely related to your growth rate. Any executive under pressure to show a good quarter has a lever sitting right there: originate less. It works instantly, and it hollows out the business over 3 years, and by the time it shows up in the numbers, the person who pulled the lever has been promoted. But here's the thing that nobody explains to you about underwriting a card. You cannot tell whether you are good at it. A cohort of accounts opened this month does not default this month. Losses on a fresh vintage start slowly, climb through the second year, and peak somewhere between 18 and 36 months after the account was opened. That curve is one of the most consistent shapes in consumer finance, and it is the reason the business is so dangerous. If you loosen your credit standards in January, your revenue goes up immediately. Your account growth looks excellent. Your marketing team looks brilliant, and nothing bad happens for 6 quarters. During those 6 quarters, you keep doing what appears to be working. By the time the first cohort's losses arrive, you have originated 6 more cohorts on the same standards. The mistake is not a mistake you can catch and stop. It's a mistake you have already repeated at scale before you receive the evidence that it was one. Every credit card company that has died in the last 40 years died of this. Not of a bad decision, of a decision that took 2 years to reveal itself while the machine kept running. And there's a selection problem sitting underneath it that never goes away. The person most eager to borrow at 22% is, on average, the person least able to repay at 22%. That's not cynicism, it's arithmetic. Anyone with cheaper options uses them. So your ideal customer occupies a very narrow band, someone who borrows persistently but never quite fails. Someone who is permanently a little short and permanently employed. That is not a stable category of person. It's a temporary condition. The revolver funding your entire income statement is 1 layoff, 1 divorce, 1 emergency room visit away from becoming your charge-off, and the transition takes about 90 days. You do not have a customer base. You have a population moving through a set of conditions, and your profit is the toll on the ones who stay in the middle. Which brings us to the part of the balance sheet that isn't on the balance sheet. When you approve someone for a $15,000 line and they carry $2,000, you have $13,000 of exposure sitting there that you have already agreed to fund and cannot easily take back. Across the American market, total credit card limits run around $5 trillion against roughly $1.2 trillion actually drawn. Nearly $4 trillion of committed credit is not being used at any given moment. You wrote that option, your customer holds it, and they will exercise it at precisely the worst time, not when things are going well, but in the month after the job ends, when the card becomes the emergency fund. Utilization spikes right before default. That's the classic signature. A customer who used 30% of a line for 4 years suddenly runs it to 90, and about 6 months later, they stop paying. You would like to react to that. You mostly can't. After the Card Act of 2009, you cannot reprice an existing balance the way you used to. You have to give notice before changing terms going forward, and you have to substantiate ability to pay. You can cut the unused portion of the line, and issuers do, aggressively, which is its own problem, because slashing lines across a stressed portfolio damages the credit scores of customers who are still paying and pushes some of them over. manage the risk too hard, and you manufacture the outcome you were avoiding. So far, this sounds like a business whose only real enemy is credit. It isn't. Credit is the enemy everyone plans for. The one that kills companies is on the other side of the balance sheet. You are not primarily a lender. You are a funder who happens to lend. Somebody has to give you the $1 billion you push out into those balances, and the price and the availability of that $1 billion decides whether you exist. There are two ways to get it: deposits, cheap, sticky, insured, boring. Or the capital markets, by bundling card receivables into securities and selling them to investors. Securitization is a beautiful funding source in good years. It is faster, it doesn't require branches, it lets a company with no depositors grow like a technology firm, and it disappears without notice. In 2008 and 2009, the market for card-backed securities effectively closed. Not repriced, closed. Every company that depended on it had to fund maturing debt with money it couldn't raise, against a loan book whose losses were simultaneously going vertical. Advanta, one of the larger standalone card issuers in the country, cut off every one of its customers' cards in a single announcement in 2009 and was in bankruptcy months later. It's not an isolated case, it's the pattern. Providian, First USA, MBNA, Household, the American monoline credit card company, as a species, no longer exists. Every survivor is attached to a deposit base. Capital One understood this earlier than anyone. It began as a pure card lender built on data and direct mail, and then spent the 2000s buying banks, not for their branches, not for their loan books, but for their deposits. It bought a funding source and stapled a card business to it. Then, in 2025, it closed a $35 billion acquisition of Discover, which bought it something else entirely, a payment network. After 30 years of paying somebody else for the rails, it bought the rails. That tells you where the leverage in this industry actually sits. The most successful card lender in the country spent decades escaping the two dependencies of being a card lender, where the money comes from, and who owns the pipe it travels through. Now the pipe, because your best revenue line does not belong to you either. That $1.75 of interchange on a $100 sale is not a market price. Nobody negotiated it. The merchant cannot shop for it, cannot refuse it if they want to accept cards, and in most cases cannot surcharge their way out of it. It exists at that level because regulators in the United States have allowed it to exist at that level, and it is one legislative session away from not existing. This is not hypothetical. It has already happened to the other half of the industry. The Durbin Amendment in 2010 capped debit interchange for large banks at roughly 21 cents plus a fraction of a percent, and debit rewards programs in America essentially ceased to exist within 2 years. Europe went further and capped credit interchange at 0.3%, less than a fifth of the American rate. Australia's central bank started squeezing it back in 2003. Go look at what a European credit card offers. There's no 2% cash back. There's no 100,000-point welcome bonus, no lounge network, no travel credit. Not because European banks are less clever, but because the revenue that funds all of it in America was capped there by a directive. Europe is the control group, and it proves the American rewards ecosystem is downstream of a permission. There are live proposals in Congress to force routing competition on credit transactions, which would do to credit interchange something close to what Durbin did to debit. And you can watch the same dynamic play out faster on the fee lines. In 2024, the Consumer Financial Protection Bureau finalized a rule capping most late fees at $8, down from the $30+ that is standard. Late fees are roughly $14 billion a year of industry revenue. That rule was vacated in court in 2025, and the money came back. But pay attention to what actually happened there. A revenue line worth $14 billion was deleted and restored by 2 decisions, neither of them made by anyone who works in the industry, in the space of about a year. You can underwrite a borrower, you cannot underwrite a rulemaking. Now here's where the money actually goes, and it's not where you'd think. You've won the interchange, you've built the rewards program, so who ends up with the value? Increasingly, the brand on the front of the card. The most valuable cards in America are co-brands, an airline, a hotel chain, a retailer. The bank does the lending, the underwriting, the funding, the servicing, the fraud, and carries 100% of the credit risk. The partner supplies a logo and a customer list, and the partner gets paid first. Delta collects around $7.5 billion a year from American Express and has publicly said it's aiming for 10. That is nearly pure margin arriving at an airline from a bank, and in several recent years, Delta's card economics have exceeded the profit of flying the actual airplanes. The airline manufactures miles at close to zero marginal cost and sells them to a bank for cash. The bank buys them with interchange and interest revenue extracted from cardholders. Ask which of those two companies has the better business, and the answer is not the one with the balance sheet. And these deals go to auction. When Costco's American Express relationship ended in 2016, the portfolio went to Citi and Visa after a bidding contest, and the terms were widely understood to be brutal for the winner. That's the structure. Every renewal is a competitive process in which 2 or 3 large banks bid against each other for the privilege of taking all the risk, and the bidding transfers the economics to the partner. You are not negotiating a partnership. You are participating in an auction where the prize is a loan book you have to defend for 7 years. The cautionary case is Goldman Sachs, a firm with unlimited capital, world-class quantitative talent, and no legacy systems decided to enter consumer credit through a partnership with Apple. It got the most desirable brand in the world on the front of the card. It also got a portfolio that skewed toward thinner credit files than it modeled, a customer service architecture it hadn't built, an operational structure where every statement came due on the same day of the month, and regulatory attention it wasn't prepared for. The consumer division lost billions of dollars. The partnership became something Goldman spent years trying to hand to somebody else, and the firm retreated from consumer lending entirely. That's the lesson worth taking. Capital was never the barrier. Goldman had all of it. The barrier is that this business punishes you for what you got wrong 2 years ago, and there is no amount of money that lets you skip the 2 years. There's one more model, and it's the only one that escapes the credit trap, which is exactly why it's the hardest to run. The premium annual fee card is not a lending product. Its customers overwhelmingly pay in full. The 2 headline premium cards in the American market now cost $795 and $895 a year, and the revenue is a subscription. You collect the fee on day 1, in cash, with no credit risk attached to it. The catch is on the cost side, and it's structural. The fee is fixed. The benefits are consumed. You promise lounge access, and lounges have square footage and a food budget, and every additional cardholder makes the lounge worse for everyone already in it. You promise travel credits and statement credits, and those are real dollars flowing out on a schedule you don't control. You promised points, and points sit on your balance sheet as a liability valued at what you estimate redemption will cost, an estimate that moves against you when customers get sophisticated about redeeming them well. So the premium card is a business where revenue is capped by what the market will pay in a year, and expenses scale with how enthusiastically your best customers use what you sold them. Success on the acquisition side directly degrades the product. The response is a permanent cycle of raising the fee and quietly reducing the value of the points, which is why every few years a program gets devalued and the internet gets angry. That devaluation isn't a betrayal. It's the only remaining lever when the cost side is growing faster than the fee. Chase learned this in public in 2016. It launched a card with a 100,000-point bonus. Demand overwhelmed every projection, and the bank reportedly absorbed something like $200 million against a single quarter's earnings for a launch that worked. That is the shape of this product. When it fails, you lose money, and when it succeeds, you lose money faster and hope to make it back over years of renewals. So how does a credit card company actually die? Not from defaults. Everybody in this business plans for defaults. They're in the model. They're in the pricing. A 4.5% loss rate is priced into a 22% APR with room to spare. Companies die because everything arrives at once. A recession doesn't send you one problem. It sends 4 on the same morning. charge-offs rise, and because of the accounting, you must immediately book the expected losses on the entire remaining book, not just the accounts already failing, so a deterioration that will play out over 3 years hits your capital in 1 quarter. At the same time, consumers spend less, so your interchange revenue falls exactly when you need it. At the same time, funding gets more expensive or stops entirely because nobody wants to buy securities backed by unsecured consumer loans in a downturn. And at the same time, your regulator raises your capital requirement because your loss forecasts just deteriorated. That's the whole failure mode. 4 correlated moves, none of them survivable in isolation, all of them scheduled to arrive together. In 2010, industry charge-off rates went past 10%, more than double the level the pricing assumes. A business earning $800 a year per good account and losing $5,000 per failed one does not have a wide margin for that. And the losses landing in 2010 were originated in 2006 and 2007 by people who had every reason at the time to believe they were doing well. Which is the thing to hold on to. In this business, the moment the numbers look best is the moment the damage is being done. The peak of your growth, the quarter your marketing works, the year you take share from a competitor, that's the vintage that shows up as a loss curve 2 years later. The reward is immediate and visible. The cost is delayed and invisible. Every incentive inside the company points the wrong way, and the only defense is a discipline that looks, from the outside and to your own board, like a failure to grow. If you do decide to build a credit card company, understand what you're actually buying. Not a loan book and not a payments business. You're buying a standing promise, made to millions of strangers, priced on who each of them appeared to be on the afternoon they applied, and redeemed by them on the worst day of their lives, at the exact moment your funding is most expensive and your revenue is falling. That promise is the product. The plastic is the receipt.